The longest win streak in 2 decades has come to an end, and in the first week of January, which has historically been one of the most bullish weeks of the year. So what does this mean for stock markets and the year ahead? Today, we discuss that and options trading and why it has so much to do with what has happened this week. But we also need to talk about non-farms. We got a very hot jobs report, and we need to talk about what it means for inflation and future rate cuts. Is a hot jobs report something to be concerned about? Let's talk about it. Hello, ladies and gentlemen. Welcome to the Daily Recap Show. My name is Chase. We do these videos every single day talking about stocks and the financial markets. If you like this video, please subscribe, leave a like. Let's get into it. Another day, another dollar for financials, particularly regional banks. They really outperformed today. Nvidia led the way with semiconductors and technology, but the big boys, Microsoft and Apple, simply didn't participate. But all in all, it was a very mixed bag of buying and selling across the board. We had winners, we had losers. Such goes the market. We had the major indices except IWM all post gains, snapping the 5-day losing streak. RSP outperformed every other index for the 6th day in a row, and this was my top index that I made in December 2023. Now, looking at the week as a whole, very brutal day for software as well as Apple. They really led the charge lower. Amazon, terrible day, same with Tesla, and healthcare, utilities, and energy, best performing sectors. Banks really did a good job as well, particularly the investment banks. They really flew under the radar. Now, globally, just something really interesting I want to point out. Look at what Japan did. Just an all-round green day. Performed the best globally there. Now, here are the sectors for the week. Utilities, healthcare, staples, defensive sectors really catching a bid, but they were also the laggards last year. And we also got a few early cycle names, regional banks, energy, and financials. As a whole, they really came through this week, but other than that, it was red across the board. And we just wrapped up a negative week in January, and normally when we get a negative week in January, it doesn't really bode well for the rest of the year. We had negative 1.66% this week. It should say 2024 there. 1 week later, 1 month, 6 months, 12 months, the hit rates in terms of percentage of years higher, it's not very strong. We normally get under 60%, even like 1 year later. Median returns are very average. Average returns are barely above 1%. And this is not the start bulls want for 2024. And if we actually look at recent history from the year 2000 to current, it's actually been very red. A red January has been a predictor of a red year. But in the 80s and 90s, it was a very different story. So hopefully we perform more like this than this. Now, looking at sentiment, 48.6% of participants are still bullish. I guarantee you that's going to drop next week. And 23.5% are still bearish. And we are seeing a normalization coming off these extreme highs we had in mid-December. Now, we are entering earnings season next week. We're kicking things off with Infosys and the big banks, JP Morgan, as well as United Health, Delta Airlines, Bank of America, Wells Fargo, BlackRock, Bank of New York Mellon, as well as a few smaller names on Tuesday. And let's dive a bit deeper into earnings. So, growth for the last quarter, Q3 2023, in the S&P 500 was at 4.1%, and the best sectors were comm services, with Google and Meta really holding comm services together, as well as discretionary, financials, and then utilities, all outperforming technology for the quarter. Now, looking at the calendar year for 2024, the S&P 500 is expected to report earnings of 11.8%, with the majority of earnings growth coming from healthcare names, comm services, and information technology. And these three sectors make up the majority of earnings, and they should be the highest because they can really make up for lackluster earnings for pretty much all of the other sectors in the S&P 500. But let's break down the upcoming quarter. And you can see we just exited the earnings recession right here after reporting earnings growth for Q3 2023. And Q4 is looking like about, we said, 3 to 4%. Goldman have a little bit of a different number here, but then we are expected to accelerate earnings all the way to 12%, 11.8% for 2024. And we do want to have a look at Q2. It's going to be a big quarter because it's the first quarter we're going to have a double-digit growth since Q2 2022. And here's an an interesting note from Goldman. They reckon that the bar ahead for Q4 results is higher than in recent quarters, but they expect S&P 500 firms in aggregate will beat analyst forecasts. And we are seeing early signs of these beats. Costco released their monthly net sales of $26.15 billion, 9.9% increase year over year, and on a constant currency basis, 8.1% increase. And a lot of it coming from non-food categories, which is seeing sequential acceleration, particularly in December. Earnings revisions are also above the historical trend. Now, normally how this works is firms will give an earnings estimate above trend, the stock will pop, then they will slowly revise those numbers all the way through up until earnings. And then when they get an earnings beat, they get a pop on the stock as well. And we are seeing earnings revisions tracking better than 2023 and the median and the average. And if we just follow the normal trend, we should beat both the median and the average, which is really, really bullish for 2024 earnings. Breaking this down into sectors and have a look at information technology. Their revisions have been to the upside, whereas the worst revisions are coming from energy, healthcare, industrials, and materials. Now, the fact that healthcare is on here is a bit concerning because they are expected to produce 19% of earnings for the S&P 500 in 2024. So we do want to keep an eye on this because this could materially affect total earnings for the S&P 500 in 2024. And looking at margins expectations are coming in lower for Q4 2023, but I think a lot of this has to do with the stronger dollar from Q3 all the way to Q4. The dollar really went on a strong rally and it only caught a bit of a breather towards the end of December, but margins are expected to increase throughout 2024. But let's keep a note on what the constant currency is and international foreign exchange conversions from local currency to US dollars. Now, where does this leave us with a valuation? The S&P 500 is currently valued at 19.4 PE next 12 months and a 2.8 EV to sales and a 3.7 free cash flow yield. Now, this free cash flow yield is actually lower than a 4% 10-year, but the difference between a bond and the S&P 500 is that earnings constantly increase. The bond, you're stuck with the whatever the yield is for its entire existence. Now let's talk about Friday's jobs numbers. NFP came in 216,000, beating the consensus. Private NFP 164, beating the consensus, and the unemployment rate stayed at 3.7%. Consensus estimates thought it was going to tick up to 3.8. You look at this, you see a hot number, but it wasn't as hot as you would think. Reason being is revisions. Non-farm revisions came in at 71,000 between October and November. Most months in 2023 were revised down. There were 500,000 total revisions throughout the year. December's probably going to see another 48,000 revisions and have NFP come in at the 170 consensus. And the total 2023 revisions wipes out the Q4 job gains. Kind of bearish stats right there when you think about it. Looking at private payrolls, now we are seeing a better revisions trend to the upside, but we did still see 55,000 worth of revisions, and NFP was revised down in all months in 2023 by a total of 600,000. But looking at the good news, the unemployment rate did stay at 3.7% and the participation rate held in there. And the prime age of participation is still well above the 2019 to 2020 average. And there's no cause for concerns until we get below this level. It has been coming down, but these things fluctuate. Employment fluctuates. Now, the thing that's worrying the Fed the most is wage inflation. We do know that autos and shelter is coming down as expected, but wage inflation is remaining sticky, and it is one of the more stickier components of CPI, and we are getting CPI next week. So we do have to watch at how much wage inflation contributes to CPI. Now, we also got ISM numbers and not much to go off. Services came below expectations, factory orders above expectations. Now, the question is, what did this do to rates? And it didn't do much. We still are expecting March rate cuts of a 25 basis point rate cuts, and all in all for 2024, we are expecting the federal funds to be at about 4, and that's about 133 basis points worth of cuts in the federal funds. Now, let's talk about gamma, guys. This is the gamma heat map, and have a look where we found support in the S&P 500, just below the 4700 area, the 4680 area. Now, I did say watch the 4650 area. It looks like investors and participants were buying ahead of the 4650 area. Now, let's dive into the technicals a little bit. Now, we are still in negative gamma ever so slightly. I do want you guys to take note that the gamma flip zone here at 4720, we're just below it, about 18 points below it. and 4600 continues to be the major put support zone. But the fact that we didn't get anywhere near the 4650 area, we were at the 4680 area, is actually kind of bullish, considering that 136 million worth of negative gamma expired, which means that a lot of dealers had to unwind their positions, and the price still stayed pretty stable at the 4700. And what a lot of people aren't talking about is this right here. A lot of positive gamma came into the tape for expiration at the January OPEX. So there is a lot of people buying the dip, and we're also seeing this in dark pools. This is the SP500 Spider Trust, and look at all of this dip buying right here, 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 and here, and especially right here. This is people buying the dip, and we know this because we saw a pop right there, and because a lot of positive gamma came into the tape. This is going to be a level that's going to be very, very key, the 4670 area in the tape, and these are signature prints, guys. Very interesting. Now let's have a look at the chart. We saw dip buyers come in at the lows right there, and we have to see what next week brings. If we see follow through, it probably means that a lot of people are looking at the 4700, 4680 area and looking at a good dip buying opportunity for the rest of 2024. And this might actually be the lows, but we do have to see what next week brings. By the looks of everything, by dark pools and gamma, this actually might be an interim low, but we'll take it day by day. And we are bullish into 2024 long term. We've been bullish all 2023 and continue to be bullish into 2024. Looking at TLT, I think this actually might be a bit of a fake out. I do think we're going to see strong support come into yields, especially with the 10-year at 4%. So what I want to see TLT do is break above here, get above the 200 moving day. I think this was probably just a stop hunt. Looking at the 10-year yield, right, this is what I'm talking about. This is a very strong resistance area right here and here. This is where we are right now. If we do break above, that's a bit concerning, but as it stands right now, we did get a rejection on this line. Looking at the equal weight, very, very strong. I said below 155, that's when we can get concerned. We found support right there, and the equal weight is holding up very, very strongly, all things considered. Looking at small caps, cash cows, this is a very interesting ETF. Just thought I'd make you guys aware of it. It beat the S&P 500 in total return last year. It's a small cap cash cows. It's just like companies that produce huge amounts of free cash flow and have high return on invested capital and return on assets. So it's pretty much like small cap quality companies. Looking at the XLF, I do want to talk about this one a little bit. Now, let's say people bought the dip at the 4700 area and we now continue higher, right? Technology moves higher, comm services moves higher, discretionary moves higher. We also want to see financials move higher with them. If that's the case, very, very bullish on financials, assuming we do go higher next week. If we continue to move down and financials continues to consolidate and beat the market and be the leader in the market, that's going to be very, very bullish for financials. But if the opposite happens and stocks start to rally and financials continue to consolidate in this area, that might be a risk off signal for cyclicals and get more into growth names, technology, comm services. So something to watch there. Financials is a big barometer for everything that's happening right now. Looking at semiconductors, this is a cup and handle that's been forming right here. As long as we're above 159, I think all dips to be met by bull demand, and we are seeing that right now. This is a weekly chart, by the way. Pretty brutal week, but we did see strong buying in semiconductors towards Friday. And looking at Nvidia, we had 3 up days in a row for Nvidia. Not much was said on Nvidia. The market is in this channel trying to figure out what Nvidia earnings are going to look like. They are trading right now at 23 times forward earnings, but that depends if those earnings materialize. The market is still undecided if that is going to happen, and that's why we've been trading in this range. But all things considered, Nvidia a bit bullish the last couple of days compared to the broader market. Looking at Apple, we're finally at the 200 moving day. I think Apple's going to find support right here. It really probably needs to consolidate for a couple of days, I think, but I do think that this is probably a good area to buy if we are going to have a look at the 200, maybe 192 level. Again, I'm not a buyer personally. I do think we probably move back up to the 200 level in Apple. And this is something I posted on Twitter. I did say that when we saw a collective bottom in semiconductors, Nvidia, and Apple and a move higher, that'll be your risk on signal. And we're starting to see that right now. We're starting to see some bullish action in Nvidia, a bottoming process in semiconductors, and maybe we found the bottom in Apple, but it does need to consolidate a bit more. But we did see buying coming at the end of the day. Keep Apple, Nvidia, financials, and semiconductors on your watch lists. They're going to be very critical for the rest of January. Looking at Tesla and It's kind of bouncing off this 200 moving day. It's broken below the trend line that a lot of people thought was going to break out. And I think it's going to continue consolidating. And I've said that for pretty much most of December. I said I didn't really believe the breakout. Tesla's just going to consolidate. And that's exactly what it's doing. And this does kind of look bearish. Now let's look at this objectively, right? This is the 52-week high. This is a 1-year chart. We came off the 52-week high, made a low, then we made a lower low, and we haven't made a higher high. We actually made a lower high and are now moving towards the 200 moving day. This is kind of bearish, things considered. What Tesla needs to do is form a low above this low and then look to break this high. That's what they really need to do. And then break 270, break 280. That's what Tesla needs to do. Otherwise, they're going to go lower, in my opinion. Uber, just super strong. Probably remain bullish on Uber as long as you're above the 200 moving day. Really would have loved this to come lower so I could get in at 55 times earnings. No, thank you. But bullish on Uber for 2024. Looking at Europe, the Stoxx 600, very, very bullish. We've broken above this trend line, this multi-year consolidation period. We've broken above it, found support. What we really need to do is build a base and look to higher price action to break these highs. But as long as we're above this 470 level, you can actually look to higher price action and break above and maybe even go for 500. What I want to see PayPal do is get above 200 moving day, consolidate for at least a month, and then we can look for higher price action, maybe even the 100, 110 level in PayPal. But fundamentally, not liking it. Mara, digital, Bitcoin miners, I think everybody was looking at this and saying, this is where I'm going to get in. And the market kind of front run it. And if you didn't get in, it's unfortunate. I am not a holder. I'll never be a holder. It's great for a trade, but there's just no way that there's just no way to know that this was going to happen. Looking at Alibaba, and at 70, I think you could probably go for a trade here. It's so deeply undervalued. I think at 70, it trades at like a 9.8 PE, kind of crazy. But what you really want to see in a stock like this is probably get above the 200 moving day, consolidate, and then move higher. But even then, like that's exactly what happened here. Consolidated for a while and still moved lower. So, it's just not worth investing in China. But it does look like China's forming a bottom with everything that's happening in the market right now. Now, looking at data for the week ahead, guys, there's quite a lot of data. We have Fed Williams' speech, but then Thursday is when everything really ramps up. Initial jobless claims, and we have CPI on Thursday, and then on Friday, PPI, as well as consumer sentiment. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit the like button, hit the notification bell. Cheers.